Ladies and gentlemen, this has never happened before. First Fed meeting in multiple years that we're actually getting a Fed rate cut. You're pricing in a 66% chance of a 50 basis point cut via the Fed funds futures market, which is going off of bond yields. Now there's a 34% chance of a 25 basis point cut. So as of right now, we're going to get a 50 basis point rate cut because the Fed basically never deviates from what the markets are pricing in. It's been over 50 years since the Fed has really surprised us. And if you look at this post from Jim Bianco, he says the market is pricing in, as I said, a 66% chance of a 50 basis point rate cut. But the overwhelming majority of economists expect 25. This is an unprecedented divergence. He says typically the day before the meeting, the odds are either 95 to 100% or 0 to 5%. So this level of uncertainty alone is unprecedented. But this is the part that really sticks out. The latest from Wall Street via 118 economists. Out of 118 economists, 101 of them think we're going to get a 25 basis point cut. 13 of them expect 50 basis points. So just that in and of itself is going to prove most economists wrong if we have these same odds heading into tomorrow morning. We're going to get a 50 basis point cut. Like, there's no arguing what the market's price in is what the Fed does. That's bottom line. So if all of these economists are wrong, how do equities respond to that? That's a very challenging question to answer, and I'll do my best to provide you my insights of what could happen to equities tomorrow and over the next couple of days here in this video. But I'll tell you, this has never happened before, or at least not in recent times, where again, Wall Street is pricing in a 50 basis point cut or a larger move from the Fed, and almost all economists are pricing in a smaller move the day before the Fed meeting. That doesn't happen. Now, yes, we can get a article or message from Nikki Leaks, and that kind of happened today in a weird way, but it wouldn't surprise me if we get another one tonight or even tomorrow morning. Now, Nick Timmerhouse writes on X, and I think there's an important message in this itself. He writes, which he's seen as kind of the guy that leaks Fed policy for us. He says the Fed faces a finely balanced set of considerations over whether to cut by 25 or 50 basis points at its meeting that begins today. The case for 50 comes down to what officials call risk management and what might be thought of as a regret minimization. Per former Dallas Fed President Rob Kaplan, if you cut 50 here and you think the Fed will need to cut again after that, you are unlikely to regret such a cut, even if the economy chugs along between now and your next meeting. But if you only cut 25 and things worsen a lot in the coming weeks, you'll feel bigger regret as you'll be behind the curve. The case for 25 boils down to some combination of one, process issues. Example, 50 will signal something more urgent. There's an election soon. Communications were not explicit enough about 50 in the run-up to this meeting. And two, a view that the economy is doing just fine and will continue to do so with more gradual reductions. And three, that because financial conditions are easy, in part because markets expect the Fed to deliver a string of cuts, igniting risks assets could make it harder to finish the inflation fight. He goes on to say in a final note about the process, when articles say, quote, this is a close call, this can be interpreted to mean that it's a matter of counting votes. And if the people who support 25 outnumber the people who support 50, then that's the way it goes. That's the wrong way to think about this for a few reasons. First, there are likely to be some people who feel more strongly about one, but can live with the other, and vice versa. There may be some in between who are legitimately uncertain about what to do, and there may be others with very strong opinions, and a dissent is possible for a cut of either magnitude. In the current circumstance, a close call doesn't mean 5-4 Supreme Court decision close. It means there's a lot of uncertainty about what's the right thing to do. In the end, Powell could probably build a reasonable consensus around either, says William English, the former director of the Monetary Affairs Division at the board. So let me summarize that. Nick Timmerhouse basically says there's a strong case for 25 or 50 basis points. That if the Fed only does 25 and the economy worsens, the Fed's going to be even further behind the curve. At the same time, if the Fed does 50, then you risk upsetting the markets, because what does the Fed know that we do not? The Fed is seen as having more information, and if the Fed is going faster, then maybe that means the economy is weakening more than we think. So that's essentially the trade-off between doing 25 or doing 50. And ultimately, Powell can probably steer the committee in one direction or the other. Given where really rates are right now and where inflation is, there is a lot of room to cut here. And I personally think Powell wants to do 50. And I think that's why we had those articles from Nick Timmerhouse. And I think we ultimately are going to get 50, because the risk here is, not doing too much, but doing too little. And the economy that does worsen from here, and you start to get an unemployment cycle recession, and that's a really hard train to stop when it starts. But again, with basically all of your qualified economists expecting 25 basis points, most of your major banks as well expecting 25, but the market's clearly pricing in 50, there is a big divergence here between what we are likely going to get, which is 50 basis points, what the markets are pricing in as most likely, which is 50 basis points, and what economists expect, which is overwhelmingly only 25 basis points. Now, if we just want to look at what equities are likely going to do, if we get 25 basis points, that could be a positive surprise for equities, because the Fed's not going as aggressive. The Fed interpreting what the markets would think here, the markets would say, maybe the economy is doing fine after all. Maybe the Fed can take their time and we're not going into a recession, and maybe the soft landing is actually coming. The Fed, in other words, is not concerned or too concerned about the economy. Vice versa, if the Fed does 50 basis points, we're getting closer to neutral faster. That's good. That's going to spur more activity in the economy over the coming months. But what does the Fed see that we are not seeing? Are they expecting more weakening? Now, I could see how we could get a dovish 50 basis point cut. The Fed could cut 50 basis points and come out and just sound super dovish. Like, we've made a lot of progress on inflation. That's why we're cutting 50 basis points. We're not cutting 50 basis points because of the economy. The economy is doing just fine. If the Fed were to come out and say something along those lines, then I think that could be seen as dovish from the Fed. If you are an equity investor, which I think all of you guys probably are, here's the big problem. The big problem is, in the short term, today is the 7th green day in a row. Okay, whenever you get this many green days in a row, you are set up for inevitable kind of big downside moves, right? It happens every time. It doesn't necessarily mean you have to enter into a correction or enter into a prolonged down period in time, but heading into such an important event tomorrow, with what is typically seen as a sell the news event, like most of the time the Fed cuts rates, whether it's for good reasons or bad reasons, stocks sell off, at least initially. With 7 now green days in a row, your odds of a sell the news event in the short term are much higher than, let's say, if we were selling off into the Fed event itself. Now, also worth mentioning, the second half of September is seasonally the worst period for markets, the worst 2-week period of any year. You also have the election risk. Whether you're looking at increased tariffs or higher corporate tax rates, none of that is reflected or priced into broader markets. And we've all been looking forward to this cut for so long. We've long priced in what rate cuts will do for markets, what that'll mean for stocks. You could, I could see, be in a scenario where the market say, hey, we priced in the good news. It's here. There's nothing else that's exciting. We didn't get much clarity from the Fed. Now we have to look forward to the election. Good news is here. It's passed. Now, election's coming around, and that's not going to be good. You have super high earnings expectations for 2025. They're still at all-time highs. Just for an example, if Kamala Harris wins and raises the corporate tax rate, that's going to take about 5% off of EPS totals for the S&P for next year. That's not reflected in markets. Who knows what tariff policies can do? So there is material downside implications for markets around the election. We haven't priced that in, and that could be the next big thing markets look forward to after we get that cut tomorrow. And it wouldn't surprise me in a short amount of time, we could start to price in some of those risks. I do think, unfortunately for the bulls, the risk is really skewed to the downside here. I think over the next coming months, once we get this sell the news event out of the way from the Fed cutting rates, again, by 50 basis points tomorrow, unless we get some, hit piece from Nick Timmerhouse or something overnight tonight, be on lookout for another leak of Fed policy coming to change those odds. If the Fed really only wants to do 25 basis points, you will get an article from Nick Timmerhouse. So be on the look for that tonight. But if we don't get that and we get a 50 basis point cut, markets are going to sell the news, probably regardless of what the size of the cut is, just because of how much strength we've had recently heading into this. And we've been looking forward to the first Fed cut for like 2 years. So it's kind of like an Nvidia event or Apple event for that matter. The stock usually runs up into that and then sells off. That's a sell the news event. It happens like those are some of the easiest trades to play, are sell the news events. When a stock runs up into an event, just short the stock. That's not financial advice, but that's like one of the literally easiest trades you can make in our markets these days. I would be very surprised if we don't see something similar to the broader markets coming tomorrow. And then we got to price in election uncertainties and then potentially lower earnings estimates for 2025, as now we've gotten the first Fed cuts, and normally that starts to happen around a recession. I think you could get some recession fears coming into markets as well, which is not something that you'll hear from your mainstream Wall Street guys here today, but that could be a larger topic of conversation over the next couple of weeks. Now, I do think once you get the election out the way, once you get, maybe a 10% correction in the books here for the S&P from these levels, keep in mind we hit a new all-time high today for the S&P in the beginning of the trading day, then I do think you could see an end of the year rally. And I do think you can position for that today. If you are bullish in markets, if you do think we're just going to continue to go higher, we're going to string 8, 9, 10, 11, 12 green days in a row. We're already at 7. Tomorrow's going to make 8 if we're green. The day after that's going to make 9. It becomes harder and harder to see the bullish case as we've had so many green days in a row. You can position in crypto plays, dividend stocks, value, cyclicals, industrials for that matter, small caps, interest rate sensitive stocks. Those would be the areas that I would be buying right now. And I would be taking some heavy profits in big tech, because big tech does not benefit at all from the Fed actually lowering rates. But again, these are only my thoughts. These are just my opinions. Let me know what you think down below in the comment section. I think we really should be on the lookout tonight for a hit piece from Nick Timmerhouse or someone else to move the odds, because if the odds stay where they are heading into tomorrow, the Fed will with certainty give us a 50 basis point rate cut, and then, well, basically every economist in the world is going to be wrong. There was only, let me double check this for you. There was only 13 economists that think we were going to get a 50 basis point cut. 10 times more economists believe only a 25 basis point cut. I'm not certain that a 50 basis point cut is going to be seen as good, right? 25 basis points, that could be seen as a little bit better, but at this point, that does not look likely. Again, as I said, Jim Bianco, the last part of this post, he says, again, just to reiterate, I cannot find another example of disagreement between Wall Street and the market pricing one day before the meeting. So you almost need to see another article from Nikki Leaks to push down the odds of 50 to 25, unless the Fed just wants to do 50 and they're willing to take whatever consequences come in the markets because of that. And I do think we will get a larger sell-off or a larger sell the news event with 50 basis points rather than 25 basis points. So I do think you want to be ready for some extreme volatility. I think you want to be excited as well, because this opens up a whole new door of opportunity for many years. Once the Fed starts to cut rates, they've made it very clear they do not want to backpedal and need to raise rates again. So the Fed's obviously going to say they're data dependent, blah, blah, blah. But this is a new Fed. This is a new economy. This is a new market. You're basically being rebirthed coming tomorrow, and different areas are going to outperform, and eventually you will see a broader base rally in our markets. It won't just be big tech participating. So if you're somebody that was not super allocated to big tech, especially you should be excited heading into tomorrow. In the short term though, you probably have a 90% chance of selling the news tomorrow. Let's just be honest. Again, if we were down 1 or 2% today, I would feel a lot more confident in saying we could see a larger rally. But markets hit all-time highs. And we're going to look back at this and say markets hit all-time highs, new all-time highs, the day before the first Fed cut on September 18th, 2024. Like, we should have known markets were going to sell off after that. And that's the short-term perspective. By the end of this year, after the election uncertainty is out the way, as long as the economy is holding up and we are not heading into a recession, then markets are going to do very well. And I think over the next 2.5 months or so, this is really your time to position for what could be maybe even a multi-year rally, as long as we avoid a recession. And I think the Fed cutting 50 basis points is actually a good thing for the economy. Wall Street's going to take that as you know, fearful. What does the Fed know that we do not know? But ultimately, we would rather the Fed cut 50 basis points and go a little too aggressive in cutting rates than not aggressive enough and enter a recession in which markets could be down for many years. So let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.